Well, hello and welcome. And thank you for taking time to attend our webinar today, Investment and Income Strategies for Your Next Chapter. We hope you'll find this content that we discussed today to be helpful. Since we're doing a webinar, there won't be an opportunity to take questions, so I'm going to ask you to write those down as we give the presentation, and then we'd be happy to follow up with you one-on-one and talk about some of the questions you might have. Also, at the conclusion of the webinar, we're going to send out a brief survey, and we really would appreciate your feedback on the content and whether you found the information to be helpful. It's also a place where you could jot down a few questions. That way we can follow up with you and maybe know ahead of time some of the things you might be interested in getting some additional information on. For those of you who don't know our firm, we're led by Kimberly DeProspero, who is my wife and partner, and myself, Hank Clear. We're both certified financial planners. We have two associate advisors, Nick Rios, who leads our financial planning department, and Chris Rios, who is also a certified financial planner and leads our business development efforts. Our operations is led by Devin Heck, and she's supported by Amy Singh. And the last member of our team is Jenny Donovan, our marketing strategist, and soon to be Jenny Rios, who is marrying Chris on November 7th. At Financial Strategies Group, we're a full-service financial planning firm, and we focus on comprehensive planning. We work with families and individuals and business owners like yourself, and we focus on areas such as retirement planning, tax planning, estate planning, along with investment management and insurance protection. We pride ourselves on being relationship-driven, not transaction-oriented, and in understanding what's most important to you and your family. So let's get started. You know, looking back, you can see stages that you've already passed through at this point in life. Childhood, adolescence, perhaps higher education, raising a family, building a career, just to name a few. Now you're looking forward to that next stage. Whether you're considering a gradual transition or a totally different life experience, there's issues and challenges that are very different than those you dealt with during your wealth accumulation years. This next stage is we used to call retirement, but now many of us think of it as a whole new chapter of our life. You know, retirement used to be thought of as a destination, but now we understand it more as a process or maybe a life stage. You know, looking forward, psychologists tell us that you're going to go through several stages in retirement. And each of these stages have both emotional and financial components. And they're commonly referred to as the go-go, the slow-go, and the no-go stages. Now, regardless how you define that next stage, you will need lifetime income, and you need a lifetime income strategy that can help you adapt to those changing income needs. Now, the stages of retirement are typically defined by your activity level. Now, these levels naturally slow down as we age. Nonetheless, our income needs continue. The amount of income that you need as you age may not go down. More importantly, it may get actually redirected. So maybe money that you might have spent on travel may now go to cover healthcare or perhaps helping your grandchildren. So even though our activity might slow down, our expenses may not. Now, there's many components in a retirement income plan. Risk management is one of the most important. And there's four primary risks that you need to address in a retirement strategy: longevity risk, inflation risk, investment risk, and behavior risk. So let's take a closer look at each of these. How long will you live? This question is virtually impossible to answer. And many retirees are surprised when they look at current statistics that are provided by insurance company mortality tables. Now, as you can see, a 65-year-old married couple has a 50% probability of at least one partner living beyond age 91. Retirements last now 20, 30, even 40 years. It is becoming commonplace. And these longer time spans must be considered when you're planning for income. Can you keep up with inflation? The longevity risk we just talked about actually magnifies the inflation risk. Over the past 25 years, the cost of goods and services have doubled or even tripled. At just a 3% inflation rate, the value of $1 actually decreases 25% every 10 years. And a 30-year retirement, you could see that your purchasing power of $1 drop to 25 cents. So a properly designed income plan will focus on maintaining that purchasing power as one of your central goals. Looking at the next 25 years, inflation rates on goods and services heavily used by seniors, like medical service or even prescription drugs, have actually been increasing at a much higher rate than the average rate of inflation. So again, planning for inflation is a moving target, and we've got to consider that inside of your retirement income plan. Now, frequent reviews of your spending, providing course correction to make sure your assets are aligned with your dynamic inflation environment is really critical to our retirees' long-term success. In the next stage, managing investment risk may be more important than it was in the past. Now, how is investment risk different? Well, many retirees experience the risk of drawing down income from their investment portfolios during 2000 and the 2009 bear markets. The combination of them withdrawing income and the decline in the market drove some of their portfolios so low that there was little chance for them to recover. The new investment risk that retirees face that they haven't really encountered while accumulating wealth is called sequence of return risk. Now, one consequence of sequence of return is that the negative impact on the longevity of your assets should you incur a negative return early in retirement. Think about the first withdrawal you've taken in 2020 after the markets dropped 30% earlier this year. That's what we're talking about. Now, having a process to avoid or transfer that risk could have a significant impact on a retirement success. Now, a popular retirement income strategy is called systematic withdrawals. Sometimes it's even referred to as the 4% rule. The 4% rule was introduced in 1994 by a financial advisor named William Begnan. Today, it does not meet the needs of retirees who have very different spending patterns than, say, retirees 25 years ago. And this strategy always exposes your asset values to the sequence of return risks that we've just talked about. It also assumes that your spending in retirement is linear, and you only need to change the amounts due to inflation. And let's face it, today's retirees' spending patterns are anything but linear. Now, it may not be possible to avoid all investment risk in order to meet your income goals, but there are strategies to help manage that risk. Addressing investment risk for retirement income purposes would include things like creating a buffer between your current income and, say, short-term market volatility, or potentially transferring that investment risk to an insurance company or institution, or perhaps a combination of both strategies. Volatility is a statistical measure of swings in returns for a given security or even investment portfolio. And a common measure of volatility is called standard deviation. Now, a simple explanation of standard deviation is how much variance in the returns can I expect given some expected rate of return? And let me simplify this a little bit. So here's an example. If I have an investment or even my investment portfolio, let's say I have an expected rate of return of 5%, and the standard deviation is 10. That means in a given year, the return on that portfolio could be as high as 15%, or it could be as low as negative 5%. Now, obviously, the higher the standard deviation, the scarier the ride can be. So developing an investment strategy that has standard deviation within your own personal risk tolerance is a major part of the work we do when we're developing a plan. Now, the strategies we use to manage and absorb this volatility is called diversification. And as you can see in this example of volatility, or if you will, the measure of standard deviation shown in red, over a recent 5-year period, it actually, when it decreased as diversification of your investments increased. So as diversification increased, what you'll notice is the rate of returns for each of the investments shown in green, they remain pretty close to the same. Now, this is a useful illustration to discuss investment management practice of diversification. However, this only shows historical performance, and we all know that past performance is no guarantee of future results. Our goal, though, in developing a retirement income plan is to achieve the needed return with the smoothest ride possible. So much like an airline pilot attempts to avoid turbulence when you're flying from one location to the next, my goal is the same. Just like all turbulence can't be avoided when flying, there will be turbulence in your investment portfolio, but diversification can help make that a smoother ride. Now, as much as we wish that there was a crystal ball that might warn us when the markets are going to go down, like yesterday, let's face it, it doesn't exist. Some advisors claim they can time the market and strategically move your money in and out of the markets at the best time. However, there's no research that has shown that this works on a consistent basis. Currently, we all know someone who claims they got out of the market before the 2008 crash. But did they get back in? And did they get back in at the right time? See, the problem with trying to time the market is there's two strategic moves that you are attempting when you time the market: when to get out and when to get back in. And you really have to get both moves right in order to be successful. On the other hand, given time, markets recover. Now, this chart shows the historic results of the S&P 500. So if you held the S&P 500 and you allowed the dividends to be reinvested over varying time horizons, and as you can see, when you hold the S&P 500 for 10 years, the S&P 500 only resulted in a loss 5% of the time. Now, to give this statistic more meaning, this analysis looked at 985 10-year rolling periods. They looked at the rolling periods from 1926 through 2017. So this means that there were only 5 times out of 985 that the S&P 500 resulted in a loss. So when investing in the stock market, time is your ally, and it can actually help in a meaningful way prevent loss of principal risk. Now, of all the risks that can negatively influence investment success, one of the most damaging is behavior risk. Many investors will move in and out of the market based on emotions, and those emotions are fear and greed. Typically, they will get out of the market as it dropped, or I should say after it's dropped, and then they're going to get back in the market after it's grown enough or the market started to come back where they feel safe again. And unfortunately, all they're doing here is they're selling at a low point and they're buying back in at a high point. Now, the research group of Delbar and Associates has analyzed investor results for many years, and they constantly find that investors are not achieving the same performance as the markets. Consistently on 20-year time horizons, they find investors are falling short of market returns on average of 4% per year. 4% per year. Now, what's going on here? Well, as you can see in this summary report, 40% of that underperformance is attributed to investor behavior, or as we like to call it, investor bad behavior. We always remind our clients that bad markets do temporary damage, but bad behavior does permanent damage. So allowing fear and greed to drive your investment decision can only result in poor returns. So let's talk about the strategy we use to address these various risks that we've talked about. Now, the strategy for providing income and managing risks that we'd like to share with you is called Income Conductor. And it's based on a time-segmented approach. By using this strategy, we can divide your retirement into bite-sized time horizons. In doing so, we can mathematically determine how much of your money will be needed for income in the short term versus, say, the midterm or even long term. We can then more confidently invest your long-term money more aggressively than your short-term money. Now, the number of segments in a plan can be customized, along with the number of years in each segment. In this strategy, the first segment is always placed in an account that has no stock market risk. This is the buffer that I was referring to earlier. The remaining accounts are left to be reinvested and grow while the first segment is delivering your income. When the first segment has completed its job, then the second segment is converted to a similar no market risk account that will deliver income over the next time horizon. Now, taking this approach really accomplishes 5 objectives. 1, it eliminates that sequence of return risk that we discussed because this strategy will never be taking income from an account that has market risk. So day to day, month to month, the markets fluctuate. It will not affect your current income because the income segment is not subject to that fluctuation. It also provides market opportunities that increase the probability of your income growing with inflation. It also easily allows us to modify along the way. The segments are typically 3 to 5 years in length and allows us to constantly reconfirm your needs throughout your retirement and update your plan accordingly. It gives retirees the confidence to take some risk with their investments since the accounts that have market risk are typically held for 10 years and longer. And it helps to protect you against your emotions driving your investment decisions. So if the markets drop significantly, you know you don't need to panic because that segment that's in the market won't be needed until years into the future. Thus, it allows you to confidently ride out a market swing. Now, as illustrated in our previous discussion on managing investment losses, you can see on this slide that the growth-oriented portfolios are not introduced until after the second segment, thus applying the time in the market strategy. Now, if we never had to deal with inflation, then a portfolio of cash and bonds could provide you a level income for the rest of your life. However, as soon as we need growth in your income, then it means we need to introduce growth assets in your plan. Once again, those growth assets are in the portfolio. Those are the ones that we will be holding for 10 years or longer. Now, although the strategy makes certain inflation assumptions at the beginning, segmentation actually allows us for inflation adjustments at each segment based on how expenses have changed versus using just some hypothetical assumption. Additionally, our strategy allows us to apply different inflation assumptions on different expense categories. And what do I mean by that? Well, your travel expenses may increase at a different rate than, say, your medical expenses. You may even have expenses that have no inflationary increases at all. An example of that would be the principal and interest payments you make on your home mortgage. So the flexibility allows us to tailor expense projections and easily monitor them during your retirement. The other risk we discussed earlier was longevity risk. This methodology allows us to address that risk by adding an additional segment at the end of your plan, which could continue inflation-adjusted income for several years beyond our original assumptions. Or, if the income is not needed, then this segment would become a legacy segment for transferring assets to your heirs. So this longevity segment may be funded using an investment account, or the longevity risk could be transferred to an insurance company using a longevity or legacy type product. Now, as you can see, there's many moving parts in a properly designed retirement income plan, like having flexibility of income, investment selection, liquidity of your investments, and the ability to adapt to changes. So not only is it important to you to consider these values when you create the plan, it's also important to have someone to help you manage the plan over time. So what could you expect from our firm? Well, there's 5 important components in your retirement performance. First, have your own personalized plan. We develop a plan that is a personalized income plan that incorporates the assets managed by us and assets held elsewhere. Your personal income plan is not based on a single asset or account, but rather it's based on the financial capital of your whole household. A disciplined approach. You know, it's natural to experience emotions like fear and greed in response to changes in the market, especially when you're retired or near retiring. Our income plan strategy can help you manage those emotions by keeping a significant buffer of fixed assets between you and those short-term market fluctuations. Next is diversification. An income plan should use diversified investment portfolios and product selections. Next, we track and we report on those products and those investment portfolios that attempt to manage risk through a global diversification. The mix is personalized to meet your income goals and also be consistent with your risk tolerance. Now, it's always important to review and make adjustments, recognizing that your income needs may vary over the stages of your retirement and market conditions may change. We will meet periodically to review the progress of your plan and make any adjustments that are necessary. And of course, all changes would be approved by you. At last, communication. You know, every step of this process would be documented and approved by you. And after reviewing a proposed plan, an approved plan report would be created outlining the details of your personalized plan. Each time we meet, you'll receive a report on your progress and any changes that we agree to make to the plan at that time. For many of you, this was a refresher course on your current strategy. However, if you're new, and you're new to us and our firm, as a result of you attending this presentation, you're entitled to a no-cost appointment. And we would meet to determine if our services would be beneficial. Now, during that meeting, we would discuss your specific goals, objectives, and discuss how we're compensated for the services we provide to our clients. Also, please understand that today's discussion is a broad description, and no one should take any of the information we've provided as a specific recommendation or specific advice. I'd like to thank everybody for joining us, and we welcome the opportunity to speak with you in the future. As a reminder, we are going to send out a short survey at the conclusion, and we would really appreciate your feedback. So I'm sorry that we can't open things up for more discussion. Due to regulatory environment now, people are not allowed to type in questions and things of that nature. So we have found that the best way to do is just to follow up with individuals one-on-one, and we'd be happy to answer your questions. So again, thank you very much. And I hope you enjoy the rest of your day, and I appreciate you joining us. And if you know of other people that might be interested in joining our future webinars, please feel free at any time to forward those links or emails on to them, because we would love to help as many people as we can. So thank you very much. Have a great day.